Performances and incentives, return on investment. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email address and our phone number, and a source for these videos is McGraw-Hill Irwin, one of the big publishing companies, and a good text that they did on finance and management accounting. The topic here is performance incentives, and we all have incentives in life, and the reason we're given incentives is to encourage certain behavior. And that's also true of business. And in business, those behaviors are measured financially by some measurement of a rate of return. And if the manager or the company meets the behavior and reaches certain targets, there's going to be financial rewards, salary increases, bonuses, stock options. So that's what this section is about. I'm going to flip over to Excel here. And let's consider Levi Strauss, the jeans maker, has 3 different divisions, and we're going to measure performance by division. They have Crazy Kids Jeans that makes clothing for children. On average, that means beginning plus ending of the year divided by 2. They made an investment of $50,000 in a business that generated $100,000 in sales and a profit of $10,000. Skeptical Teen Apparel, same thing, $70,000 investment, $250,000 sales, $20,000 profit, and Heavyset Dad Clothing, investment, sales, and profit. And that brings up a new calculation called return of investment, which is profit divided by the average investment number. How much did you invest in the business to create this profit? Taken a step further, we can divide it up between the blue, which is profit divided by sales, and the green, which is sales divided by average investment. The numerator sales and the denominator sales cancel each other out, so you end up with profit divided by average investment. The information in blue, profit over sales, is return on sales. For every dollar you sell, how much of it's profit? The sales divided by average investment is called capital turnover, and we haven't seen turnover as a term lately. And I want you to think of turnover as the dollars out the door and coming back in. That's turnover. Think about turnover of number of people in and out of a restaurant. How often are you able to seat somebody at the table, have them eat a meal, pay, leave, and then come back? That's sort of like turnover in a restaurant. Capital turnover is based on that investment you made. How many dollars can you sell based on that $1 of investment? So we have our percentages down here, the return on sales numbers in the first column in blue, the capital turnover number in green, and then we have the return on investment number in the black headed column here. And we can see that Skeptical Teen has the highest return on investment. And specifically, they had the highest amount of profit as a percentage when compared with their average investment. There's only a couple ways that we can change or increase ROI, return on investment. We can increase prices. That can be difficult because we may get resistance from customers. We can decrease expenses, which unfortunately is usually the first technique that companies go to. Or we can lower the invested capital, meaning that it requires fewer dollars invested to get the same results. So what you'll see in the second tab here under Changed Performance, we're going to say that with Crazy Kids Jeans, we increased prices 12%. Expenses stayed the same, so our profit went up to $22,000 in comparison with what was on the prior page. Increase prices, sell the same amount. Skeptical Teen, we reduce expenses $30,000, our price remains the same, our sales dollars remain the same, our profit increases that way. Heavyset Dad, we lower the average investment $20,000. It was $150,000, now it's $130,000. Profit stays the same. Based on those changes, you'll see that our return on investment, our profit divided by average investment, goes up in all 3 cases. Before we were at 20, 29, 14, reading down at the far right-hand column. After the changes, 44, 71, and 16%. So all three categories increased. All three categories increased. So what I'd like you to get out of this is that what we have in financial changes in the right-hand column are the three ways that we can change our return on investment. That's as far as we get on part 1 of our performance incentives. You'll find part 2 on YouTube soon. Our YouTube channel, Ken Boyd STL, has a variety of videos, including several on this topic. I'm going to change that bullet point later. You can find a complete listing on a video listing Excel document at our website, stltest.net. We do live tutoring and chat sessions, both one-on-one and in groups. Here's our email address and our phone number, and we'll see you next time.